It's not quite your Archduke moment. Had China turned around and said no more lithium exports, that is the Archduke moment, right? I would actually suggest, gallium and germanium, yeah, kind of connected to the semiconductor industry, used in those formats. I regard this as another front of the semiconductor war. I mean, we know the US has been very aggressive about cutting China out of its semiconductor supply chains and not sharing technology. In that context, it makes a lot of sense what China has done as a quid pro quo, right? Um, it's an important symbolic moment. I mean, there will be short-term disruption to both germanium and gallium supplies, but you're right. It is symbolic of something that's going on here. What you're seeing is a decoupling of China and the US specifically, but the European Union will follow across the metal spectrum.
The assassination of Archduke Franz Ferdinand was the kickoff to World War I. Did we see something similar in the base metals or in the metal space this week as well? China stopped or canceled exports of germanium and gallium. Admittedly, smaller markets, about $230 million in total volume. But was that the kickoff to something greater? We'll see. There's a bit of a trade war on technology happening in the background as we were speaking. So I'm curious how this is all playing out. Again, we also have other massive topics to discuss with our guests today. It's Andy Holm of Thomson Reuters. He's the senior commodity analyst or columnist over at Thomson Reuters, and somebody I've been following on Twitter for a while now, have a huge respect for. You can often see me retweet or summarize some of his columns on Twitter as well, because it's just phenomenal content. I have to admit, I'm a bit nervous about this discussion, and it's probably the discussion I've had the most notes for, because there's so much going on to talk about. And I'm really excited to have Andy on the program and appreciate your time. Andy, so great to see you.
Yeah, and thank you very much for the invitation, Kai. Sort of like it's a pleasure to be here. Yeah, and you're right. There's a lot going on in the metal space right now.
Yeah, absolutely. Like I've been preparing for 2 hours, and like just before you came on Zoom here as well, I still kept making notes about like where I might want to take this discussion. I opened with a bit of a World War I anecdote here, just to set things off. But we also could have talked about people being asleep at the wheel at the LME, for example, during the nickel crisis, just to start things off there as well. There's just so much to discuss.
Yeah,
In the commodity, in the base metal space in particular. I'm excited about this conversation. Let's start though, Andy, and let's start with a general question as well. You put out a column just last night or yesterday, and I think it's a good kicking off point because it sort of summarizes a bit where the economy is right now and where the base metals complex in general is right now. Do you want to start us off with, Andy, how are we doing? How's the base commodity space right now?
yeah. It's very interesting. I mean, at the start of this year, I think there was a lot of optimism in the base metal markets, right? And the optimism was based on China. China had a tumultuous year last year. I mean, severe lockdowns, strict lockdowns, and they kind of pivoted away from that policy. Coming into the new year, everyone thinks, well, okay, we're going to see a mega rebound from China, right? It's going to come roaring back. And we've seen this before. We've seen the use of stimulus packages to to get the economy going and all that. A lot of optimism around, and you'll see if you look at base metal prices, they all had a really strong January. Everyone's sort of like buying into this China reopening story, right? All right, let's fast forward 6 months. Where are we? Right, Chinese manufacturing sector has been contracting for the last 3 months, right? Um, the property sector, there's still no end in sight to its problems, right? You've got youth unemployment rising. I mean, in essence, the good news story for China has just dissipated. And worse than that, of course, you have Chinese manufacturing in a technical recession, but we also have that sort of weakness spreading to the European economy and to the US economy. If you look at purchasing managers' indices, they're a great indicator of what's going on underneath the bonnet of these sectors. They are all signaling contraction, right? And of course, base metal prices, have pulled back. I mean, the disappointment is there. I think when I looked at the core six base metals traded on the LME, only one tin was higher at the end of June than it was at the start of January, right? All the others, to varying degrees, are now below their year start levels. And that just tells you what the metals think about where the what I call the old manufacturing economy is going. And it just bears out exactly what the PMIs are telling you. It's hard for base metal prices to rally if you're looking at a global manufacturing recession.
Recession is a good keyword because we've been discussing this here on the channel as well, and it's a bit of a Godot recession as well because everybody's been anticipating it, but we don't really see it if you look at other indicators like the unemployment rate, for example. But the PMIs are telling you that we're in a clear recession, or the ISM as well. The Institute of Supply Management as well is telling you we're in a recession. Right, so it's interesting. It's a bit of a bifurcation as well because the market can't seem to make up its mind whether we are in a true recession or not. Right.
I think there's two sort of like background trends that we kind of should be aware of a little bit, right? So let's start off with China. So great expectations of a supercharged rebound in manufacturing activity based on the emergence from lockdown. What actually happened in the first 2 or 3 months of this year was when China's indicators were picking up, all the growth was coming from the consumer side of it. It wasn't coming from the manufacturing side, right? It was manufacturing light as a recovery in the first 3 months of this year. Goes back to can't kickstart that property sector, a key driver of metals demand, right? So it's not that China sort of like didn't recover at all. It's just that the recovery was very sort of weighted towards consumer spending and weighted against sort of like manufacturing output. So that's one key thing. It is, it's a slightly different sort of economic sort of like recovery than we've kind of grown used to in China. And the second thing which really complicates this is, right, and I wrote about this in the column yesterday, right? Historically, the industrial cycle is the key determinant of base metal prices, right? Where we all get used to looking at the PMIs, we look at industrial production figures, and as I said when I started off, okay, we got all three major sort of economic regions are now sort of like in negative territory for the manufacturing PMIs, right? So it's a slam dunk. Obviously, it's a recessionary environment for base metals, and you expect prices to go down, except maybe the base metals relationship with industrial production is changing. What do I mean by that? As more and more metals are used in green energy applications, such as grid spend, such as EVs, that comes in as a sort of counterpoint, if you like, to broader industrial activity. So I would argue that, looking at sort of the world around me, base metal prices should be a lot lower than they are on a historical basis. I mean, we've got all three major regions are contracting in terms of sort of manufacturing. One of the reasons I suspect we're not lower is there is some now counterpull from, say, for example, Chinese grid spending. The property sector is terribly weak in China. They're struggling to work out how to sort of deal with that. But you look at grid spending. Oh, yeah, that's really accelerating now after about 5 or 6 years of flatlining. This is a new generation of grid that is being installed, a smarter grid, more geared towards renewable sources. So it's kind of helping to compensate, if you like, for the old industrial economy. And I would say that's happening also in Europe, and it's happening in the US, maybe not quite yet to the same extent as China. But we're going to look at this kind of like counter-cyclical pattern, if you like, because, of course, infrastructure spend, green energy transmission spend is not cyclical. It's government-led. And I mean that in all three areas increasingly, right? Well, we used to say this is the way China does it. You look at the way European Union's doing it, you look at the way the US government is doing it. This is government-led stimulus into but very specific parts of the economy. So I think it's a confusing picture from that point of view, right? We've got headline sort of like manufacturing activity bad. Look underneath the surface, though, specific areas performing very strong indeed. And so kind of got the likes of copper, it's kind of caught between what I call the old economy cycle and the green economy cycle. And that's why it's confusing, right? I mean, everyone's trying to get their heads around this at the moment. It's not quite behaving in the way it has done in previous cycles. And I would suggest that is the first sign of what I call green energy, sort of like, pool on the base metals.
It's interesting, and I mentioned to you before we hit the record button as well. Like I wrote down one thing, like the price doesn't make me a believer yet, and in that regard, I meant sort of the everybody screaming from the rooftops that we're running into a massive supply deficit, and it feels like I've heard it before, and it's repeating itself, and then all of a sudden, like we have a rug pull or so, and nothing happens, right? So, but you made some excellent points there that it's right in the middle of it. We have the old economy sort of, I wouldn't say disappearing, but maybe slowing down, while the new economy, call it the green transition, is picking up the slack here. U.S. Infrastructure Act, for example, right? Sorry, the Inflation Reduction Act, not Infrastructure Act, is kicking in there as well, I think. So I'm curious, like, is it really? It's like, who should we follow maybe for some predictions as a follow-up question to that? Because I look at the Glencores and the Trafigures of the world when they present somewhere, I listen carefully. Do you do the same?
Yeah, of course. I mean, they're the biggest players in town. I mean, whether I agree with them or not, I've got to be aware of what they say. Look, I mean, look at something like copper. Copper's a really, really nice example of this. Yeah, I mean, classic. I mean, Dr. Copper, called Dr. Copper because he could tell you everything about the world manufacturing economy at any one state and time, right? On that basis, copper should be lower. Yeah, there's no doubt about it. You look at the historical past patterns. I mean, you look at all three major economic blocks are contracting in terms of a traditional use of copper, but it's not. And it's not lower because there is good demand coming through like green channels. And there is this long-term story, a bull narrative around copper. It is a core enabler of the green technology revolution, right? Whether you talk about EVs, grid, doesn't matter. Copper's in there. So those expectations, I mean, they're correct. I mean, there is no way that, I mean, we're going to sort of decarbonize without using a lot more copper. Absolutely. It's just that we're seeing this, we're having this conversation right now in a terrible environment for the old economy. And let's, again, I'm going to go back to this. What was the single biggest driver of metals over the, let's say, the 2010s? China's property sector. They were building new cities at the space of one every 6 months. You just imagine sort of like building, a new Frankfurt every single 6 months. How much concrete, how much rebar, how much sort of copper, everything, right? So it became, as I said, the key driver of not just base metals, ferrous metals, the whole lot, right? It became the global driver just because no one had built so much before in such a short period of time, right? And that's why what's happening in the Chinese property sector is the single biggest drag on every metal that you can count on, right? But so you've got to, it's almost like a quantum world. Do I believe that there is going to be a sort of like a super cycle for metals based on like green energy transformation? Yes, I do. Do I think that's going to happen today? Not quite yet. No, it's not built up enough sort of like momentum to allow copper to break free of that old industrial cycle, right? We're in a halfway point here. So you have a situation when the likes of Trafigura, when the likes of Glencore said, copper could go to $15,000 per ton. That's possible. That's absolutely possible. The question becomes timing. Right? I don't think it's going to go to $50,000 a ton when every other component of copper demand is struggling. But you get a situation that, I mean, if we get out of this industrial cycle, the recessionary cycle, and that then combines with the green channels of demand, you could see something spectacular. But just right now, as you said, the copper price is saying it's not ready. Yeah, that is exactly what the copper price is telling you. And we'll know when that changes, when the copper price starts moving upwards. But as I said, I mean, it's above $8,000 per ton. Look at the charts. This is a high price for copper. It's a high price for copper when every PMI tells you that, I mean, demand for copper is going down, right? So that, as I said, is the juxtaposition now. It's becoming a much more complex set of equations that are going on behind these metals.
I brought up supply in my previous question. I'm curious now. We got to look at inventories, right? So like, how do the inventories look? Because coming from the precious metal side, the term silver squeeze is used to push prices higher. Do you expect a copper squeeze or base metal squeeze anytime soon? Like, what's the inventory situation? Is the question.
Yeah, I mean the inventory situation on exchange stocks, London Metal Exchange stocks, CME stocks. Shanghai Futures Exchange stocks, what we can see, it is dire. These stocks are extremely low. You talk about squeezes. Listen, there is hardly any metal over the last 2 years that has not had a brief squeeze or even several squeezes. Actually, tin is just going through another squeeze at the moment, predicated on those large stocks, right? This is another one of those really difficult questions. Everyone likes monitoring the LME stocks because they're a point of hard data in an industry which doesn't have a lot of hard data. We're not like the oil and gas industry when there's a lot of great stats around, right? Most of us don't even really know how much China produces in terms of copper and zinc, right? So we have to accept that, but we also have to just see them for what they are, right? They are what is sitting in the market of last resort, yeah? And historically, maybe there was more in the market of last resort than there is now. Maybe trading patterns have changed a little bit. What do I mean by that? Well, let's look at some of the last 2 years. Let's look at zinc, for example. Great example. Zinc had a lot of supply problems, right? I mean, smelter problems last year, and a lot of disruption to flows of metal around the world. This all kind of comes back to, started with COVID, then it became the European power crisis. Anyway, a lot of disruption in zinc. Now, I imagine myself, if I am a major zinc merchant, right? Let's say I've got 40,000 tons of stocks. In times gone by, I could probably just park those in the London Metal Exchange. Why not? I would suggest now that those units are more valuable to me in the physical supply chain than they are in the futures market, right? You look at the premiums for physical metal, they're very high. And also, if I deliver that to the LME, I may not get it back. Even if I buy back my position, I may not get the same zinc. So would I necessarily deliver to the LME this time around? I'm not sure I would. I might be very happy to hedge that stuff. I'm just keep it in my own private warehouses because I need it. I need it. I'm not going to give it to the market of last resort. I am the market of last resort. I need that metal for my customers. Another smelter goes down in Europe. I may have a problem with that if I have a marketing agreement. Why would I deliver that metal to where I can't control it? So it's possible that after the last 2 years, LME stocks are telling us two things, right? One is, there's not a lot of metal around, but even more importantly, what there is around is the guys who own it don't want to give it to the LME. They don't have to. They're under no obligation to, right? They'll do it if it makes sense for them. But if it makes more sense for me to say, I'm going to hold my stock. I'm just because I can get good premiums for this, and I have worries about replacing my stock. I mean, depending on the level of disruption, it may be that we're also seeing a shift of trading behavior around LME stocks. Now, at the end of the day, on the LME, you can only trade what's available in the system. So you have these persistent sort of like squeezes. I mean, I think only one metal, nickel, did not see a squeeze in the first 6 months of this year, even in a lower price environment, right? When they get squeezed hard, as you're seeing in tin, metal is being delivered into the market. So it's out there. I just think that there is traders, big merchants value that metal so much that LME delivery is not necessarily an obvious option in, say, maybe the way it was 7 or 8 years ago. And that means that LME stocks have lost some of their signaling power. Not all of it, but some of their signaling power is blurred now. So when we look at, say, copper, and I think there's about 40,000 tons of available metal in the LME system. Do I think that reflects the world outside the LME? No, I don't. I think there's a lot more copper out there. But the very fact that guys are kind of hoarding it, keeping it like this to themselves, right? That tells you quite a lot about the state of the market through their eyes. Yeah, they're not doing it necessarily to squeeze the LME. It probably starts off as a defensive strategy. I've got my metal and I want these brands, and my customer may need these brands. I'm not going to deliver to the LME. Yeah. Then, of course, that can then be combined with a more aggressive play. If I know I'm doing that, I can put an aggressive play on the LME. That's a different thing. But the starting point is, it may not be people going out, I'm going to go and squeeze the copper market. It's just, I've got so much tonnage. I'm looking around the world. I don't want to lose that tonnage. I need that tonnage, and it's not going to the enemy. It's not going to CME unless I get caught in a short squeeze and I have to deliver. Real market of last resort stuff. So low stocks, yes. Is the world that short of metal as suggested by LME stocks? I would say no. But why is no one delivering? That also suggests a wariness about availability going forward, right?
Interesting. Like one thought that came to mind is the ghost warehouses in Southeast Asia that apparently Glencore runs for copper. That's where my mind just went. So it gives a lot of credibility to that sort of article I read a couple of years ago, I think. Right. So
Yeah, I mean, as I said, there is no law of exchanges that if I have surplus metal, I have to deliver it to you, the London Metal Exchange. I will do so if that makes sense to me. And I think what you're seeing in large stocks is a lot of people saying that doesn't make sense. That's not my first choice anymore. I don't
interesting.
want to give it away to the market. That metal, I mean, it is so specific. And if I've got specific brands that I'm sitting on, again, I don't want to lose those brands to the wash of the LME sort of clearinghouse. I want to keep those. So there's possibly a bullish element to this, which is kind of like a secondary bullish element, right? The world is not as bullish as LME stocks tell you, but the way people are kind of keeping their metal away from it does suggest a bullish outlook, right?
Yeah, definitely. Andy, allow me one last question to sort of follow up on the inventory discussion here is with the looming recession that we officially are not in yet, like, do you see a bit of a, what do you call it? It's a bit of a cushioning effect, maybe. It's like, I'm missing a word here, but like a relief, maybe a bit of a relief on the supply situation with the recession. Does that allow maybe to replenish some of the stocks that have been depleted?
I think we would hope so, right? Because I mean, these markets desperately need to get their stock levels up again. The question, of course, then arises: where will the stocks be accumulated? Will they be accumulated in private storage? Will they be accumulated on the London Metal Exchange, for example? The jury out on that one. As I said, when these markets get squeezed, it then becomes an obvious choice if you have metal to deliver physical metal into that squeeze, right? But if I'm not being squeezed, I may not be so incentivized as I was in the past to do so, right? So yeah, a more complex situation. I suspect the role of stocks is changing, but quite how it's changing, where we end up, I'm not sure yet.
No, interesting. Love your takes here. It's really insightful what you're sharing here with us because it's interesting. The LME and the LME is in a crisis in itself, and maybe we'll start talk about that for a second. What happened there in March 2022? The courts are just working through it as well, and we're getting glimpses on a daily basis here from various reports. I think Bloomberg put something out this morning. You've been covering it as well. Just the situation at the markets and lack of oversight in general as well. Do you want to quickly recap the LME nickel crisis for us and what that actually means for the market in general?
Yeah, sure. I mean, so this starts with what I would call, I mean, a slow burn short squeeze, right? So you can go back to the start of the year. Actually, if you want to look at the Shanghai Futures Exchange nickel contract, you can go back to the year prior, right? You basically have a structure of positions in the market. You have big shorts in there. Some of them held by Tsingshan Group, which is now known. They've got all the publicity, but I mean they were not the only ones sitting on the short side, right? Why are they short? Their view is we are bringing on all this capacity in Indonesia. We think this is going to flood the market. We think the price will go down. It's a very logical like trading pattern if you think about it. Particularly since they are probably hedging short anyway, their long physical position, so you can tweak around that, right? On the other side, we have bull contrarians. And the bull contrarians also have a very valid point, which is that like LME stocks are going down. You guys are producing all the stuff in Indonesia, but it's not LME deliverable nickel. Therefore, we think the price is justified at this level. So this is one of those classic sort of big standoffs you get in markets sometimes, right? You got a bunch of powerful players on the short side, you got a bunch of powerful players on the long side, and they are just basically doing battle across the LME 3-month price and particularly across LME spreads, right? And then Russia invades Ukraine at the end of February 2022. Why is this significant? Russia is a major producer of nickel. right? It is also a major producer of the nickel that can be delivered to the London Metal Exchange, what we call Class 1 nickel, refined pure metal nickel, right? So, of course, everyone thinks, hold on, what if they, are we going to ban Russian nickel? Are we going to sanction it? And the price starts rising. This is, again, a completely normal reaction, right? As you can imagine. By the way, we should just say now, Russian nickel remains officially unsanctioned to this day, right? There are penal import duties by the US and the UK, but everywhere else there are no official sanctions, but the fear of sanctions was completely reasonable. What starts happening? The price starts rising fast. Now our big short positions have a problem, right? This price is running right into their sort of like, stop loss, like areas, right? So they had to start covering now, right? The more they cover, the more the price rises. This is the classic short squeeze, yeah? The more the price rises, the more what I call, more predatory players come in the long side, pushing the price up further, forcing more covering. So this is the background market situation. The price explodes at the start of March. We go from $20,000 per ton to $50,000 per ton. And then on that key trading morning, I think it was the 8th of March, we go to over $100,000 per ton in the space of about 15 minutes. That's the shorts desperately trying to cover back their position. All right. So there's two complications around this. The first is, as I've mentioned already, we have a couple of very, very big, powerful industry players on the short side. In any other market, rather than having to buy back painfully sort of like expensive positions, they could just go, you know what? I'm delivering you 50,000 tons of metal. There you are, end of squeeze. Problem is, they don't produce the right sort of metal for LME delivery. They produce, nickel comes in many, many, many different forms, right? So what the Indonesians are producing is nickel pig iron, ferronickel, nickel matte, nickel sulfate now. It's a whole huge industry, but it doesn't produce 1 ton metal that could be delivered to the LME. So that physical delivery get out, if you like, is not available to these guys. They only can get out through buying back. Yeah. Nightmare situation, but one that, we've been here before in the nickel market, by the way. This is a well-known problem of the LME nickel contract. Now, the second complication is a lot of these positions on both sides, by the way, but let's talk about the short sides, were on the over-the-counter market. So the LME comes in, the LME compliance comes and looks at, it can see every position on the market, and it's going to see some like short positions there, right? But it has no idea how big the short positions are. All it can see is that net tiny bit coming in at the end, which is being hedged directly on the LME. What's lying out there is a mystery to the LME. And what was lying out there was massive short positions. Massive short positions, right? So that combination of, we've got a big short, he can't deliver physically against the short position, and he's going to have to buy back. And the LME, you don't even really understand how big that short position is until it's too late. That created, I would say, the environment for what I call the meltdown of the whole contract, right? Because this comes down, sort of like to not only is the price moving, but remember, every time the price moves higher, it affects the margin call of those short position holders. So suddenly you're looking at billions of dollars of variation margin are becoming due, right? And then it goes up to 20 billion. People are running out of money, not least the LME brokers themselves, who have to stand between the LME clearing system and the end customer, if you like. So this melt up in price actually creates a credit meltdown on the LME. Yeah. And they are looking at the potential of multiple defaults amongst their members. And one of the reasons they suspended the market in the end was to preserve the integrity of the LME ecosystem. Because once one member goes, member A goes, I'm out. I cannot afford to meet these margin calls, and my customers just defaulted on me. I'm going to have to default, right? He defaults. Then brokers B and C go, hold on, he's just defaulted on us. Now we can't pay. And there you could create your domino effect. I think by the end of the day, the LME reckoned there were about 9 members were potentially facing default. So the decision to suspend the market, okay. More controversial was the decision to suspend the market and then say, we're cancelling the last 6 hours of orders because we don't think those were valid orders at a valid price. And that is really at the heart of the legal action, right? I think the rule book of the LME states that it has those powers to suspend any market it wants to if it thinks it is necessary. And I think even the guys, the hedge funds on the other side of this legal action, accept that. What they say is, okay, but you didn't have to cancel our trades. That's a separate thing, right? We traded legitimately at prices of up to $101,000 per ton. You can't just take that away. You can't cancel them. There were other options available for you. So it's a double action sort of lawsuit. Was the decision to sort of like suspend the market like legitimate? I think on that one, the LME's probably got a good defense. And then the secondary decision, okay, once you suspended the market, did you have to cancel all those trades that had already been executed? That is kind of a much more difficult area, if you think. And to be honest with you, I have no way which way the judges are going to decide on this. And I don't think anyone does.
It's interesting because there's billions at stake, right? As you said, there's at least nine that owed $100 million or would have owed $100 million each at least, right? So somebody lost money, but also somebody made $1 billion. So there is quite a bit at stake here.
Yeah, absolutely. I mean, and the damages claims. I mean, first off, we should also say that, I mean, although the legal action was taken by only 2 financial players, there's at least 5 or 6 other ones waiting in the wings to see whether this judicial review is upheld. The damages could get ugly. But as I said, I mean, we just simply cannot preempt a decision by a UK court. I mean, the law is a different beast as well for markets, right?
Exactly. Is there anything we learned from this event, though? Did the LME learn anything from it? I know they sort of raised the margin requirements even during the process. While it was happening, they raised those requirements. But were those permanent? And where are we at now? Like, what did we learn?
Okay, so I mean, the LME is going to have I've always said the LME only evolves through crisis, right? This is its latest crisis. And it has already changed a lot on the London Metal Exchange. So, for example, in the past, the LME, and I guess representing sort of the views of the London authorities, the UK authorities, has been a very light touch regulatory exchange. The view is the market is paramount, the market is right. We will not intervene in any way unless we absolutely have to. Well, obviously, that didn't play out well in the nickel crisis. So what you see now is the introduction of things that have previously been taboo for the LME. So we have lending caps, which are permanent now. I mean, I have to lend to you a certain amount per day. I cannot take your eyes out on lending, right? We have volatility caps. I mean, we have price band caps, right? All of this was absolutely, as I said, anathema to the LME as recently as 3 or 4 years ago. And it needs to happen because, these markets have become much more volatile, basis on low stocks. They become much more dangerous markets. And the LME has now put in safety nets. By the way, these safety nets are standard in US exchanges. They're standard in the Chinese exchanges. The LME rode against that trend for many years. So it's going to become, it is already a more controlled trading environment, right? These things are going to become permanent. The second big thing, what did they learn, is, you've got to understand on the LME, there's always been an OTC, over-the-counter element. It comes from an overseas business, right? If I contract with you to send you 20 tons of aluminium, Kai, that's our business, right? I mean, we may hedge that on the LME, but our contract is an OTC contract between you and me. Why should I talk to the LME about that? So it's always been rooted in OTC world. But I think that OTC trading world has grown bigger around the LME, and it's quite clear that they did not understand what was happening in that world, right? They took too much comfort from what they could see and didn't raise the question of, we should ask more about what we can't see. And that becomes quite controversial. So they said, okay, we need more information about the OTC markets. Don't expect that to be unresisted by some of the players in the market. Again, for the basis that, look, if I do physical contracts, why on earth would I tell you what is very private business between myself and my clients, right? If I do a hedging structure around that and we'd agree to keep it OTC, again, why should I tell you? It's not automatic. I mean, legally, that you actually have the right to ask me this. And yet the LME has said, without that information, we have no real way of understanding what's going on in this market. So I think, I think the LME is going to have another big evolutionary step here.
Yeah.
It probably needs to happen. I think the idea of, and I think London's changing as well. Our laissez-faire attitude to financial regulation. Let's look at the big picture of the last 15 years. We've had the LIBOR scandal, the gold fix scandal, the LME nickel scandal. It's too much. And basically, this idea of letting markets be who markets are, I don't know whether this is sustainable. I suspect the UK is going to have to sort of like change its view about regulating markets. I think this is part of a shift in culture within the UK authorities. And I think the LME is going to be caught up in that now. It's kind of like, okay, guys, these days when I could just control all the LME stocks and I'm going to charge Kai this much money for him to roll it, and I could do anything I want and the LME won't really intervene. I think those days are over. I mean, I don't think they can't continue, right? And if you look forward, if you believe some of the stuff that is said about these markets because of the green transition, they are going to become more volatile at a higher base pricing level with periodically very large stocks. So maybe it is time now to actually say, guys, this market needs safety ropes. We can't exist without safety ropes anymore. Yeah,
it's also part of a relevancy discussion, I'd say, as well. Like looking at what is happening now on in the green economy side, when the automakers go straight to the producers and buy straight from the producer, right? So that's where my mind just went when you were talking about that, like bypassing the LME, doing OTC trades, as you said, where I don't know, maybe a bad example, Tesla goes straight to a nickel supplier and says, okay, I'm going to buy X amount of nickel directly from you, sort of bypassing the market. Is that the right example I'm using here?
Yeah, I mean, although I've got to be a little bit careful about that because, I mean, there's the issue of physical supply, which is really what's driven the automotive companies to try and get units, if you like. And there's the issue of price. Just because I've secured my own supply does not mean I've secured my own price, if you think about it, right? So the likes of a Volkswagen, for example, will take a 5-year hedging program for every input it takes, whether it's coming from its controlled mines or not. It wants to have price management structures. So theoretically, they're not inimical to each other. So just because I have a physical supply contract with, say, a mine, it doesn't mean I won't hedge the price of that contract, because the chances are it won't be a fixed price from the mine. And even if I own it completely, we need to have an internal sort of price equilibrium to understand how our business model is working. And hedging is probably going to be part of that, yeah? So I don't think that is quite the killer blow to LME, as it were, right? It's a change of the industry, but that price risk cannot just be removed by me taking a stake in a mine. Yeah.
Okay. No, makes sense. Okay, appreciate the clarifying. That's sort of where my mind went. I'm sure others probably, hopefully as well. Okay, perfect. We discussed the element. We have to talk about the opening topic that I mentioned in the intro. Is the trade war? We need to come to this. We need to maybe close with this as well. I used an extreme example, obviously, trying get people interested as well. But the assassination of Archduke Franz Ferdinand to kick off World War I. Maybe a bit extreme as an example, but what we've just seen this week is China sort of putting a ban on exports of certain metals, meaning, do I say properly, germanium and gallium as well. Smaller markets, 225, 230 million markets, but they produce 80% of it, right? So I'm really curious what your sort of view on that is, and is it a trigger to something bigger?
All right, so it's not quite your Archduke moment. Had China turned around and said no more lithium exports, that is the Archduke moment, right? I would actually suggest, gallium and germanium, kind of connected to the semiconductor industry, used in those formats. I regard this as another front of the semiconductor war. First and foremost, right? I mean, we know the US has been very aggressive about cutting China out of its semiconductor supply chains and not sharing technology. In that context, it makes a lot of sense what China has done as a quid pro quo, right? It's very specific, and it's a small tonnage is involved. It's an important symbolic moment. There will be short-term disruption to both germanium and gallium supplies, but look, They're small tonnages. The West does have the capacity to pick up the slack. It might take a little bit of a while. At the end of the day, this is absolutely survivable. Yeah. But you're right. It is symbolic of something that's going on here. What you're seeing is a decoupling of China and the US specifically, but the European Union will follow across the metal spectrum. Yeah. Um, and a lot of the skirmish battles, if you like, will be fought out of these very minor, small, esoteric metals like germanium and gallium. They're not yet going to go all the way up and fight them over aluminium or copper, but you are looking at a much broader based decoupling of metallic supply chains. We have relied in the West on China to basically process our raw materials and send us finished goods. Yeah. To the extent that you look at some specific metallic markets, China is kind of like controls the supply chain. This started, I would say, about 5 or 6 years ago in the US, and it started with the US military. You cannot identify, as the Pentagon did, you can identify China as your biggest long-term threat without having in mind to the fact that your army relies on materials that come almost exclusively for China. So this drive started with the Pentagon, and so far it's played out in, if you think germanium sort of like, an esoteric metal, there's other much weirder ones out there, right? And things like, boron magnets. The US military is already now prohibited from having anything Chinese in those magnets, right? So it's been playing out at the periphery of the metals world, but it is part of a much bigger trend of the West is going to try and decouple as much as it can from Chinese metallic supply chains. You look at something like germanium actually can be done and gallium can be done. These are quite weird metals. They come as byproducts to zinc production. So you've already seen over the last 24 hours, I think I've seen 3 producers in the West say, hey, that's bad news, but we can actually help you out here, right? If you, for example, if China said, right, no more lithium hydroxide and no more batteries, guys, that is a really big escalation. I don't think we're ready for that yet, but and even the gallium and germanium, it's not happened yet. They're calling the producers in to talk about how they want to do this. So I guess there's going to be a little surge to get to buy from China in the next couple of weeks.
August 1st, I think, is the deadline, isn't it?
There you go. But it's a warning shot. It's another warning shot.
Andy, to sort of wrap up the conversation, I quickly want to shoot some rapid fire questions at you because I want to look at the other base metals as well, in particular tin and also zinc. I'm just curious what the situations are there because we've covered copper and I think nickel at length now. But let's start off with tin. And I was talking with some friends who follow the market closely as well. And they told me to ask you one particular question, as most of the inventory is actually owned by one party on the tin side. So I'm curious what your sort of assessment of the tin market is. You mentioned earlier where it might be in a price squeeze right now, but also what is the inventory situation?
Well, look, it sounds very sinister, doesn't it, when you say one person controls 50% of the stocks, but what if the stocks are only 1,200 tons? It's a ridiculously low level of tin stocks on the LME. So you could end up owning half of that without even wanting to own half of that. It's a very small market. And what I would say, though, is this is one of those squeezes that's a positive for the market, because what we've seen is a lot of tin being delivered in. So we've got over 3,000 tons of stocks now. This is okay. If you're bullish and you've got a bull position on, it's horrible, but actually from the point of view of the health of the market, you can't operate at all like a market on that low stock level. It's ridiculous. It means you're constantly having price volatility. You're constantly having squeezes. It's a positive thing for visible stocks to rebuild in this market. Actually, tin is a fascinating sort of I call it the energy transition metal. Everyone forgets, or everyone thinks it's about tin packaging. That's only about 13% of usage now. 50% of usage is circuit board soldering, right? It is the glue of the internet from that point of view, right? You cannot have something that is so important with only 800 tons of stocks available. So the rebuild in stock, this squeezes if it generates a better cushion of inventory, it's a good thing. And tin is always going to be a small market. It's always going to sort of small moves of stocks can have a big outsized impact. At the moment, we're seeing a stocks rebuild both in China and in the LME. It has been occasioned by a squeeze. This is the market doing what it should do, right? This is the market being challenged. We need some more tin, and the tin is being delivered. Yes, I mean, short term, it's probably negative for price, but I would say, tin has such a strong narrative story going forward. Don't worry about that. I mean, we cannot have something. I mean, which is so critical to the next the industrial revolution, coming, 5G and all that, which has so little stocks and has such a high price. I mean, it's a good thing, if you like, for stocks to rebuild. I think combined now between Shanghai Futures Exchange, LME, we must be over the 10,000 ton level, probably for the first time in several years. But if you go back in time, LME used to have 20,000, 30,000 tons of tin stocks. That wasn't unusual. So we just got down to such a depleted level that, I mean, frankly, sort of I put on a small hedging program. I own half the stocks. I mean, and that's not a good situation for any market to find itself in. So disappointing for bulls at the moment. Oh, it's not quite going the way they want. I would say, okay, if you're a tin bull, you'll have your moments. This is good for the health of the market. Let's get that inventory buffer in again, really, because something that is so important cannot be in scarce supply, I mean, all the time. Yeah.
Now, it's interesting because we've seen a couple new mining companies or exploration companies pop up recently as well in the last 24 months, solely focused on tin. Something I personally, and I've been in the market for 12, 13 years now, I hadn't seen, or I wasn't even aware of, that tin companies existed, right? Even in the UK.
Yeah, I mean, look, I mean, tin's a very strange industry. I mean, it's kind of dominated by a handful of probably about 10 or 11 players, to be honest with you. 6 are Chinese. Amongst the others, a couple of state-owned. So, I mean, Bolivian tin operations are state-owned. The biggest mine producer of the stuff outside of Indonesia is Myanmar, where tin production is controlled by the United Wa Army, which is an armed ethnic group. It's a very strange production profile. And if I look at where the tin's coming from and the dynamics of the supply chain, it desperately needs to have a more diverse supply. And I think that's what guys are looking at. So people are going back to the old tin mines in the UK, the old tin mines in Australia, and say, is there can we go back and get tin out of the ground here? And it has a great long-term usage story. As I said, no circuit board exists without tin.
Yeah, the glue of the internet. I love that term. Fantastic.
The glue of the internet.
Andy, thank you so much for your assessment on the tin market. But I think I saved the bigger topic for last is zinc. Lots happening in the European markets right now. Boliden dominating the news as well. Smelters shutting down. The high power prices to blame to a degree. But there's lots more going on, Andy. Tell us about the zinc market and what's your assessment?
Yeah, I love the zinc market because, I mean, it's okay. Let's rewind a little bit. Let's go back about 2-3 years, so before COVID comes along, right? The zinc market has been through a period of short supply, mine problems, mine supply, etc. But from about 2020 onwards, right? Here's the narrative for zinc: mine supply is going to actually experience a surge, a boom, right? That's going to be obviously translated into more refined metal. The price comes down. Fine. This is the narrative around zinc. It's pretty much a consensus narrative. Two things happen. First off, we have the disruption of COVID. So quite a lot of zinc mines in South America get closed down. So like that. That's our supply shock number one. Fine. COVID kind of ends, and that mine supply or the concentrates are sort of ready for refining, yeah? And then we have the European energy crisis, and we have about 3 or 4 smelters go down in Europe. So suddenly we've got a smelter bottleneck. So yet again, sort of like the era of everyone's expecting lower prices, more zinc. No. The mine material is there now. Now we haven't got the smelters. Now the smelters are coming back. Great. Although a couple remain out in Europe, right? But in the interim, the price has hit a level where mines are becoming unprofitable now. And you mentioned the Tara mine in Ireland. Look, every mine has its own curious individual characteristics. That includes Tara, which has geotechnical issues there, which maybe other mines don't have. Anyway, it is a warning sign that this price has now hit a sort of like somewhere into that producer pain threshold, if you like. Now, having said which, so it's a market that everyone has traded from the supply side. But that supply has kept on moving around. So first of all, we had no concentrates because of COVID. Then we get the concentrates back to hit the smelters. Then the smelters go down because of the energy crisis, right? Now we're getting smelters creep back, but now we've got mines going down. So it is a very sort of disruptive picture, if you like, for a market that really should have a very clear-cut bear narrative around it. I mean, demand's not great. Again, galvanized steel, very closely tied to the construction sector. Go back to my previous comments about China. Yeah. But I mean, it's one of those things. It should probably be the bear trend should have been much faster and more clear cut. But supply just does not sort of conform to how people think the story should run, right? And you get this juxtaposition of mines being out, mines coming back. Smelters going out, smelters coming back. Some smelters still being out. Now mines going out. It is, as I said, it entertains me a lot. It's not an easy market to put an easy narrative around, which is what people have been trying to do. Which is why I think it must be a very difficult market to trade. So sometimes I thank myself I don't actually have to trade certain markets. Zinc's one of those.
Look at the price action here as well. It's painful. It's just $2,300 per ton right now, so it's trending down as well. It's interesting, definitely an interesting market.
Yeah, and as I said, it is particularly exposed to construction, and it's particularly exposed to Chinese construction. That's really, and also, I mean, automotive. Obviously, anything we use galvanized zinc sheet for, right? Those are probably two of the weakest areas of the global economy right now. I mean, so we should not be surprised to see prices lower, but Boliden's closure of Tara, that's your warning shot. Much lower than here, you're going to see more mine closures. You're in the cost curve, obviously. I mean, the closure is a proof of that. So, I mean, logically, you would say there may be more downside for zinc, but if we're going to see more mine closures, this is how commodity markets work, right? I push out the marginal producer, the market rebalances. That was the significance for me of Tara. I wasn't personally expecting it to come. There may be specific issues around Tara, obviously. But yeah, this is your warning shot, people. We're now trading somewhere into that producer pain threshold. If you keep on pushing it lower, expect more closures.
Fantastic. Andy, exceptional insights. We're going to wrap it up here. I've tremendously enjoyed the conversation. One last question. When can we expect the next column, and what is it going to be about?
Actually, the next column will be out tomorrow, and I think it will be about the European Union belatedly but correctly adding aluminium to its critical minerals list. It was shocking to anyone in the industry that it wasn't included. And there has been obviously a quick U-turn by the European Commission on this, and they have just included aluminium as a critical mineral, which is interesting for both what it says about aluminium's use in the green energy sort of revolution, but also what it says about the current state of supply for Europe, which has relied historically on Russian aluminium. Yeah.
Difficult situation there. Very difficult. Fantastic. Andy, thank you so much. Where can we find more of you? Reuters.com, obviously, you're columnist there, but you run Twitter profile quite actively as well.
Yeah, look, I mean, I always say the simplest way to find me is you take Google or other search engines are available and you type in 3 words with inverted commas around them, Andy Home Reuters. You will find me. Don't worry about it.
Fantastic. Andy, again, thank you so much for your time. Truly appreciate it. Wealth of knowledge on the base metal side. Truly, truly appreciate it. Everybody else, thank you so much for diving in. Bit of a different discussion here on the channel because often we talk gold, silver, obviously, and main markets. I hugely enjoyed this discussion with Andy. I learned a lot as well. As I said in the intro, it's probably the conversation I had the most notes for. We probably could have spent 2-3 more hours on just everything here. There's so much going on in the space now. Don't think I would have said that again, like Andy sort of said 12 months ago, even. If I feel like things have changed, Really curious what you think. Put it in the comments below. And also right here, there, it says subscribe on it. Hit that button. We truly appreciate it because it helps us bring guests like Andy on the channel. It really helps us. I think we can all learn a lot. And I know Andy doesn't do a lot of interviews. At least I couldn't find too many on YouTube. So I'm really excited that he joined us. It's thanks to you. Thanks for subscribing. Leave a comment, leave a like, and we'll be back with lots more. Thank you so much.